welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Andrew Falde from SMB Capital. Before we get started, we have a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And just again, this is for educational purposes only. And this disclaimer is on all of our web pages if you want to read it in its entirety. And Andrew has similar disclaimers at SMB that basically say it's for educational purposes only. So Andrew, welcome. This is the first time we've had you on the roundtable, and like we were talking before the recording started, that we've known each other for a little while, and it's nice to reconnect, and it's great to have you here.
I'm glad to be here. Thanks for the invite, and there's hopefully some new information that I can share today, and it might inspire people to use a little different style of analysis and preparation for the markets.
Yeah, and maybe people who don't know you, maybe just a minute or two about who you are and what you do so they get a better feel of your background.
Right. Most in the options community probably know me through SMB Capital and SMB Training. I'm affiliated with them. I'm based in Fort Myers, Florida, though. My trading is actually with a private group down here in Fort Myers, and I started out as a student with SMB and developed a relationship with them and with Seth, and also with the systems group and Rick Martin, that is, they're in charge of the systems trading. So learned a lot about algorithm development and have been in the pursuit of applying that to more effective option strategies since then. Prior to being in options trading, just for background, I was in commercial real estate with two of the largest commercial real estate organizations in the world, and right around 2009, I kind of had a realization that the real estate industry is very local and very cyclical, and basically you really only do well when the market's moving in one direction. So I wanted to move into markets that allowed me to profit no matter what was going on a macro level, and especially in a local market. So at the time, I knew somebody that had investments with a options trading hedge fund, and this is 2009, 2008, and they were, especially through 2009, but part of 2007, 2008 as well. And things were just looked so terrible out there, and this options hedge fund was making money. So once we figured out they weren't doing anything illegal, we said, well, let's figure out exactly how this works. So I've been learning that ever since and applying it for capital management and having a great time with it. So that's just a little background.
Fantastic.
So I can just hop right in if you want. And
yeah, great. I see a familiar piece of software.
Yeah. So this is Monte Carlo, if you're not familiar, but if you're at a capital discussions meeting, you probably heard about this before. We actually had them on a special options try meeting as well recently. And this is brand new for me. I've actually only run about a dozen tests so far, and I've just really started learning the software, and I'm definitely not here to do any training on it. But it was good timing. I was able to run a couple of tests just to show as an example the topic I was going to discuss. So this just gives one more, it was a back test I was able to run very quickly. I was very impressed, very happy with it. I'm excited about what I'm going to be able to develop with this. But I was able to run a 10.5-year back test with one idea, and it took probably 10 minutes to set it up as far as writing out the rules and making sure I did everything right and fixed anything I got wrong. And as I get better with this, it'll probably take even less time. And then it took about 2 or 3 minutes to run a 10.5-year back test on a strategy. So what would have been either a long day at least, but probably several days of as much as I could handle staring at the screen and keeping my hands on the mouse and the keyboard to do a back test, I was able to get that done in just a few minutes, which means every time I get that information, I can document it and go on to the next set of parameters that I want to test, and it's going to be really a great thing. So if you're not familiar with it, it's probably a good idea to learn, and there's probably more training out there as Quanti Carlo gets more popular. We'll be learning new strategies. So what I'm doing today is this is going to be kind of a working meeting. I like the topic or the title of these as roundtable, more so than a webinar. This is training by example. This is just going to show you some information that I have, and then I'm going to get into showing you some ways that you can pull data yourself. So Quanti Carlo may be too complicated for you, may be too challenging. There's a lot of there's a steep learning curve. It's not a very long learning curve, but it's pretty steep that you have to go through. But there's some other tools that we can look at. But the topic that we're discussing is, I'll state it as a question. The question is, what if you could have filters that can keep you out of bigger drawdowns? And not all drawdowns, but can keep you out of the really big ones. And I'm going to use the recent example, the Monday in August where we had I believe it was the largest gap opening in the Russell 2000 and possibly also the SPX as far as a point basis, because we're obviously at higher point levels, so point base, it's easier to put on more points on the board. But I don't know about percentage basis, but very large gap opening after we had already been selling off, and that created a lot of heartache and stress for market neutral options traders. So the question is, could you have done something about that? Is there something you could have seen or known ahead of time that would help you have at least a smaller drawdown, maybe half size? Maybe you would be out of the market. Those that have been working with me for a while have heard, if you've been in groups with me or have any training with me, I've tried to make it very clear over the last year or so that I firmly believe that around a 200 moving average, whether it's a 200 moving average, through algorithm studies, it's technically the 190 exponential average technically is the most robust filter for this as far as the underlying markets go, and that in robust I mean works for the Russell 2000, the S&P 500, it works for Apple, it works for a lot of stocks, it works for a lot of ETFs, and just kind of tends to aggregate that it's not always the 190 exponential moving average, but more often than not it is the 190 exponential average, and it often is a great filter for bullish and neutral strategies to only be long above that 190 or 200 exponential or simple moving average, right in that range. So I've had evidence for a long time through a couple of back tests, because back testing used to take a lot of time, and then I would infer some of that from underlying price data, and then I would also use it to back out of some other back tests and just say, well, this period of time we would have been below, so you could take out these trades and the equity curve should be better. So at this point, it only sounds like theory unless you've seen any of that information, so I'm just going to pull up a little bit of evidence about that. So what I have here is, this is an equity curve. A theoretical equity curve is backtesting simulation, as we discussed in the disclaimers, starting with a $100,000 account. And this is selling a single put at a 20 delta about 40 days to expiration. So it starts trying to open up a trade around 40 days expiration, or whichever trading day shows up after that, and sells a 20 delta put and leaves it alone. It does absolutely nothing after that. This is just simply a no touch, no management, just sell it and let it expire and let it go. So this is, and you can just eyeball see that here's the financial crisis, here's the flash crash, and here's August 2011. So these are periods of time that we know well as far as big drawdowns in a strategy like this, just a pure premium selling strategy. The purpose of this is not to talk about this being a reliable or a good strategy, because the returns are very low and the drawdowns are very high. It is profitable. It does work, but it is not something I would recommend or would trade myself without something else with it, without some type of a hedge or without some type of a signal to get out before the loss draws down too far. So we have, just to look at these numbers simply, we have a net profit of a single put. The 100,000 mark doesn't really matter. It's just what does a single put look like. So I'll just kind of zoom in like this. A single put being sold for the last 10.5 years is a $31,000 net profit and a max drawdown of $17,000. There's a lot of other figures in here, and we're not focusing on that right now. I'm just looking for answering the one question. What if there's a filter that can help you reduce drawdown and not greatly impact your profitability or greatly impact your trade frequency, other things that would make it not practical to do that? So one other thing we can take a quick note of here is the 92% win rate. So that is to be expected in a strategy like this. So, and that is, by the way, a 20 delta put. I'm nearly certain it was a 20 delta. Now I'm having doubts because I don't know if I did 15 or 20. But anyways, 15 or 20, I'm just going to stick with 20 because I'm pretty sure that's what it was. 20 delta and common sense or common practice or common knowledge, common teaching is that when you sell 20 delta, you would say that you have an 80% chance of success. And here we see, even with a couple of bear markets and some really big moves, this one actually ended up at 92% win rate. So there's just a little evidence of implied volatility being a little overpriced, and that the put skew showing you that there's just a little less probability, a little more premium being paid than those expect. So there's those numbers, 31 positive with a total draw, a max drawdown of 17,000 and a 92% win rate. So I apply here simply, and I could go back and also do this, but I really actually just did this afternoon after recently learning Monte Carlo and thinking, well, maybe this would be good information to show as evidence, and so I was able to pull it, and I just did it as a 200 period moving average, simple moving average. I just picked the less mystical number. I just used the round number and the simple moving average to keep it very basic. That if you were to only do this, only sell the puts and only hold the puts. That means you only enter the position if we're above the 200 moving average, and you close it if we trade below the 200, meaning we close below the 200 moving average, you would get out of the trade. So here's the equity curve of using that filter to say, where can I reduce my excessive volatility, my crash scenarios? You do not get out of the flash crash in this scenario. The flash crash happened from up high. That is one of the anomalies of the flash crash. Most large down moves happen after a down move has already started. So that was just one that we're not able to filter out. And if you do filter it out, I would accuse you, or at least encourage you to figure out, I wouldn't accuse you of anything, but I would encourage you to consider that you possibly curve fit that data just to remove that one loss, and it may not be reliable. So just a simple filter of a bear market, you could call it, below a 200 moving average. So let's look at the numbers. We had a $31,000 max or a total net profit in the other version of just sell it no matter what and let it go. In this one, we have 27, so not a big difference. Still have a high return. But look at the max drawdown. We had a $17,000 max drawdown with the no filter version that we sell puts even in a bear market. And this would be, I will conservatively call this 1/3 of a drawdown, and probably it's a little bit, well, 5,500, let's see. 17, yeah, we'll call it 1/3, approximately 1/3. So 1/3 the drawdown for just a little less return. I would say that would be an effective filter. We have 10 years of data, that's pretty good. More would be better, more markets would be better, and that's not, you know, it used to be that would be a difficult thing and a time-consuming thing to go and get, but at this point I'll be able to pull more of that information. But this is really just intended, and still, this is not something I would say is tradable. This is a low return strategy over 10.5 years to return 27% in 10.5 years. That is not outstanding by any means. It is a margin intensive strategy, and the return on max drawdown is still not too great on an annualized basis. So the purpose of this is to say, is it possible that filters can help reduce drawdown without greatly impacting the upside of the trades? And this would be a little bit of evidence of that being the case. We do see the win rate drops a little, and that is due to the trades that are closed at a loss when they cross below the 200 moving average. So if you open a trade and it crosses below and you're in a drawdown and you take that off, you may have more losers, but you possibly have, well, we've seen here, you have smaller losers. So you're going to take a few more losers, but you're going to have smaller losses. That is just the nature of a super high probability trade. Typically has that every once in a while big loss to it, big drawdown. And I actually tend to believe that you're better off on a no-touch strategy or a very simple strategy. You're better off looking for a win rate that isn't in the 90s of a percentile, because that would indicate to me that when you lose, it could be a more risky loss, and you don't have enough data about how many losses. And historically, that could be accumulated in a row that would cause a lot of problems. So very good. Also with this, there's a few other figures here that I have a little bit of knowledge about, but these are, correct me if I'm wrong, Tom, the confidence index or confidence interval? Interval, okay. So that is proprietary to Quanti Carlo, I believe. So this one, it's still pretty wide range, but actually even the lowest one is still positive, which is pretty good. But that's really, those figures matter most if you are actually developing something you would want to trade. And at this point, we're just looking at filters. So that's one example. Now let's look at something else. This is a chart of SPX, which is not the one I wanted to look at. So let me switch it back over. Not that it matters, it's just not the one I have the information on here. So that was a simple one. That is a 200-day moving average, 200-period moving average on the daily chart to filter out the biggest bear market moves, those crash scenarios, basically, and even some other larger ones like August 2011 was a larger down move, and it's not on the chart. The data doesn't go through last month, but that would also help you reduce your drawdown. Let me just open that up so you can see. And here I am in the SPX again, but it doesn't matter that much. If I can get here.
Andrew, do you think you could go full screen on that? It would probably be easier for people to see.
Why not? Yeah. It's also it's a big monitor, so it probably doesn't translate very well. So here's the 190, I believe, exponential average. Yes, 190 exponential average is one of the few indicators I look at on the chart itself. Even if you've seen me look at other ones, I'm typically not actually observing them in any way, but the 190 is one I follow very strictly. And during this time, because of the research I had done over all of this period before it, I said, when we get below the 190, I believe that is a viable filter to either not trade if you don't have a lot of experience, or at least to cut size in half. So on this day, I cut size in half. I reinitiated full size above, and on this day, I went to half size again. On this day, I was going to go back to full size, but then because that was right at the close, and before I could do anything, we were back below. So on this big decline, I was actually in half size in my managed accounts, which means my drawdown was about half of what it would have been if I was not using that filter. It was, I say about, because I had a little bit of bias that was less neutral, not exactly rule following on this day, thinking this is overextended. So I let it go just a little bit bullish at this point. So if I was following some sort of stricter rules, it probably would have been exactly half size for any strategic basis. But so to cut a drawdown in half is very good. There's other things I use too, but we're looking as far as filtering. It's not what the topic we're going to discuss exactly, but another thing I look at, 190 is for trend, and I also look at a 9-period exponential average for mean reversion to make sure that I don't over adjust into extended moves. So let me just add one here, or I'll just temporarily change this one. So it's 9-period average. So you see sometimes you get extended below, and then you get extended above, and then you get extended below, and then you come back to it. And when you're extended below, you often come back to it. The reality is that line moves also, but it's a great way to make sure you're not over adjusting. You don't want to recenter, especially if you're in an actively managed profile, recenter a spread all the way up at 1266 on this day just because the market's been taking off for a while, especially if you had recentered the position all the way down at 1208 here. If you're following the 9 moving average, you're only adjusting your profile between 1223, so that saves you 15 points, and then the highest you would have adjusted to would be 1252, and you would have waited to do it even a few more days, not all the way up 10 points higher. So that saves you probably 25, 30 points of adjustments by using something that kind of keeps you a little bit more centered and follows the price action but doesn't chase it. So here was a scenario where on the down day I was rolling down and adjusting and defending the downside. However, I left the peak profit, I left it up at 1180. And then the next day I made some more minor adjustments down to around 1165 or so. And then the lowest I ever adjusted to would be in the 1150 range. I don't follow it to the penny here, but around 1150 I slowly got there, and you can see we've been trading up and above and below that ever since. And so that many things, these filters, I have a filter for large volatility, a filter for crash scenarios of the 190 exponential average, so I cut size, makes a big difference. Then I have a filter that says don't over adjust, make sure you're looking at the 9 moving average to see where the likely mean reversion is. Be strict about moving with the 9 moving average, but don't follow price when it's far extended away from moving average. Make sure you trail behind it a little bit and kind of stay in the mean area. So that helped a lot to just take small incremental adjustments until the market found a bounce. That was a wonderful recovery. And then this whole time of grinding along has been a great recovery as well. Some accounts going back to probably where I was over here, and other ones just slightly behind it. So much more manageable. It's kind of like this picture over here. You're always going to have drawdowns, but if you can minimize them, if you can keep them smaller, you can keep your whipsaw adjustments from being too often or too frequent, where you're adjusting down too low, then up too high, then down too low, then up too high, and then here down way too low. Those are very valuable filters as well. So now I want to go even a step further. We have the 190 exponential average is the big filter to look for extreme volatility and crash scenarios, to reduce size or take a vacation. We historically don't spend very much time below that moving average, and when we do spend a lot of time, volatility gets very high, and we can see crazy market conditions, which is very challenging. So it's a good time to just cut size and work on other strategies, and don't be aggressive about your trading. And then the mean reversion filtering. So then I want to go even further and say, what about something a little bit more short-term directional? So I have long-term directional, the 190 average. Then I have short-term mean reversion, which would be my 9 exponential average. But I really want short-term, intermediate-term, directional. And that is probably one of the most challenging pursuits that I've been on for several years now, looking for short-term directional signals for options. Very challenging. So I spent a lot of time working on, I think Preston's here, so you just saw his name there as well. So Preston, there you are. You're on the screen. So I've been looking for directional signals that work on indexes. Typically, directional signals work best on stocks. They work best on futures, stocks, currencies, and not all futures markets, but index products, ETF products, low beta stocks, which means low volatility or low relative volatility, typically don't have good momentum. They don't trade momentum very well. So let me make sure I'm even on the right chart here. Oh, I see, that's the buy and hold. Okay, so looking for something that works on indexes, very challenging. And here's an example. Let me pull up the code. This is a mess of a piece of code here, but this is really the only 2 lines being looked at here. And really, I'll be brave and delete some stuff. Just to let you know that this is a really simple signal. Value, I'll leave that. I get rid of that. Make this 12. All right, see if I broke anything. Might take a second with the webinar software. Okay, looks good. So very, very simple signal of a momentum signal, 12-bar look back, saying if we close above the close of 12 bars ago, then buy 100 shares, which I would call, one contract, basically, equivalent. And then if we close below the close of 12 bars ago, then sell. Very simple script, very simple code that follows the momentum signal. The momentum indicator is actually just a rise over run. It is probably one of the most simple momentum indicators as far as how to calculate it. It is simply looking at where we are now and where we were X number of bars ago. Another way to think about that in the real world, if you wanted to know how steep something was, like a roof or a roadway or a sidewalk, like a ramp, you would measure where we are at the beginning point, then you would go a certain distance out, so call it 10 feet, and then you would look at the change, and that would be your slope. That's your rate of change from over that 10 feet. So a steep roof would have a higher slope because it would rise more number of feet over that 10 feet. So I'm taking a wild guess. I'm not a roofer, contractor or anything, but so a steep roof might be 3 feet of rise over 10 feet of run, and a shallow roof might be 1 foot. So here we have that same figure. This is saying that 3.91. So the market has risen 3.91 points since 12 bars ago. So 12 bars ago, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So here's 12 bars ago, and we are slightly above that. So that is called positive momentum over 12 bars. So just so you know, if you've ever seen that indicator and you weren't quite sure what it was doing, that's how simple it is. And I like simple. I want to test simple things before I test complex things. So we see here, it kept us out of this big drawdown. You think, oh, that's a good sign so far. We got a lot of these red numbers. I always forget, some don't recognize what this means, but this would be the signal to buy, and this is the signal to sell. And if it's a red line sloping down, that would be a losing trade, a losing signal at least. We're not trading the index. You can't trade the index, but it's a signal. So you see a lot of losing signals here when the market's weak. And then when it wins, you say, market starts rising, we get positive momentum. So we went from just below zero and we popped way above zero. It buys, it holds for a long time, and then when it crosses below, it sells. Very simple. When we are lower than we were 12 bars ago, it closes. When we're above 12 bars ago, we buy. I think I don't have enough data on here. We do 10 years. All right, I think, yeah, lots of good. So big run, really nice. Little whipsaws. Anything directional tends to be quick losers and long winners on average. Tends to be small and frequent losers, and then fewer winners, but they last a long time. So that's that example there. So looks pretty good. You think you got some big winners, you got smaller losers. with winners piling up and losers not being as long, you'd think maybe this could generate a profit. So I look at the underlying signals, and I see, it's calculating. A little slow. Okay, so we see here an equity curve. That's not very pretty, right? So it starts at 0, it draws way down, it pulls up to here, and then barely starts going to a profit, and then we're almost back to 0. So we have a 10-year period of just about flat overall gains with a big drawdown. So Tom, is that exciting? Are you glad that I've shown you this signal? Do you think this is going to be valuable?
Oh, absolutely.
Yeah, this looks great. So you're wondering now, so Andrew, what you're talking about this indicator, you're telling me it looks good. We're trying to find ways to reduce drawdown, and I just showed you an indicator that has a big drawdown and somehow climbs back up, and then we ultimately end back at even. So not so exciting. However, we are here because we're options traders, and I would venture a guess that 90% or more of the audience here believes that premium selling is the right side of the market to be on, at least to have reliability in your trading. So what I have beyond the signals, the signals are the underlying, as if I was going to buy the Russell 2000 index or the IWM stock or the TF futures. That's what that's looking at. But there's other information here as far as the statistics of these trades, because what I'm looking for is I want smaller drawdowns, and I want to be out during the excessive down moves. If I'm going to be a primarily premium seller, and there's more premium on the put side of the market, so that's where you're going to get more of your premium anyways. If you're in a weird or type trade, the downside of the market is more risky. If you're in an M3 type of trade, the downside of the market is more risky. There's more absolute risk in that direction. So that's why I'm looking for these ways to avoid those biggest down moves. So here in the statistics, we see only 33% profitable on these signals. Not so exciting still. And then trade analysis, here's where we start to see the value. All trades 12 days average, winners 23 days. So when you have a signal that works, on average, you get 23 days where the market stays above 12 bars ago. And that's a trailing number, so there's actually times that it can go against your initial entry point, but it is typically not very much, and you have these longer periods by watching the signal. 23 days. And as premium sellers, days in the trade, having trades open for a long time that are working is what works best for us. What we have here is the losers are only about 7 days, 6.5 days on average. We're obviously looking at just daily bars, so it's an average number. So a little over 6 days on average. And we see here also, there's two numbers up here. I'm using 100, usually I use a $100,000 nominal position because then I can convert this to a percent. But let's see if I can come down here and see something. I can't, let's see. That might tell me something. We'll just look at dollars, which is fine. So on a dollar basis, we have a $2,500 typical win on a winner, which if I used a $100,000 position, I would say that's a 2.5. It closes 2.5% in your favor after 23 days on average. And on a loser, it's 7 days. So you still had some time in the trade, but it's that smaller drawdown, only 1.2%, or here half as big as the winner, we could say. So we say these are decent statistics. I have, when I get a good signal, I'm in the trade for a long time, it's going to go in my favor, and I can let my premium work. I'm not going to have excessive volatility in the trade, assuming you're either just selling put spreads or you have a strategy that you can manage the upside pretty easily. Or you can even start to be a little bit more aggressive about the upside and maybe lean your profile. If you're a trader that tends to try to stay bearish most of the time, a signal like this might tell you to maybe soften up on that and try to be a little more proactive about the upside of the market. So all of this, we have some statistics now. We have a signal that doesn't look so great on the underlying, but we have some statistics that look favorable. And again, I'm using very simple indicators to let you know there's not some secret about algorithms or anything like that. I do have more complex stuff that I would follow a little more faithfully than a momentum signal, but this gets the point across. Let me pull up one more thing. This is the buy and hold. See if it, yeah. Buy and hold, I'll just keep this. What it is, it looks like a number of trades, but what I did just to have a similar, because we have that average 12-bar holder or so, I did a 20-day, just to give us some data points to look at, but buy and hold is basically every 20 days it just sells and then buys back the position. So this shows you that buy and hold actually would have done a little bit better as far as total return. So you see it actually ends up higher. This is the buy and hold. So then I'm going to switch back to the momentum. Has a $35,000 drawdown. Buy and hold. Okay, I don't have the right sizing on here. Let me just see if I can quickly. Fix that. So I'm going to do 100 shares, just like the other one, so we have the same data. And I'm even going to do 12. All right. It's not perfect, but it'll get us there. All right, so we have similar drawdowns on the signals. And so the buy and hold actually appears to be better. But if we look at detailed, on our detail, which is between our trades, we go down, we have these sharper down moves on the buy and hold. And on the momentum signal, you can see that a lot of those sharp down moves, they're actually turned flat because we're out of the market during those, and the losses are short, little pull downs. So these are just little things that I see as evidence of this is a signal that can allow me to be neutral or bullish in the market and allow premium decay, but not necessarily have to be right on direction. So I did a back test of the same signal. So before I give away too much, let me go back to this. I'm already there. Go back to line. All right, so this is the back test of the underlying signal as if you were buying the Russell 2000 index or the TF futures or the IWM shares. This is what those signals would generate as far as your return. Not exciting. This is taking the exact same signals but applying a 30 delta put spread, short put spread. So you can see it has a completely different equity curve as far as the drawdown and total run up. And that is because one primary thing, and I could do some statistics with 5, 10. What I do want to do some of this and show you how to run quick calculations in Excel. To look at this, and I might do it here, but I might just do something else instead as far as testing another signal. So you can see total drawdown is minimal. This is obviously the financial crisis. You're going to get that bigger drawdown during the worst moments of that. But overall, it tracks a lot better. The point where it really was declining on the underlying, which is here, it's tracking sideways. And then we have the big sharp move. We do participate in that. But then all of this, which barely was able to climb up, was excellent signals for holding premium decay positions. So I like to go back and make sure I include the financial crisis. I like to make sure I have the flash crash. I like to make sure I have August 2011. So that's why specifically, and I had to do this one manually. So in the future, I won't have to do those as often since I have Monte Carlo. So, but manually, I tested from before the financial crisis, through it, and all the way to near the end of last year. So I got those really high volatility environments that have happened during the financial crisis and since then. So that's that. And then, so I want to say why this is the case. How does this? We know it's premium decay. what happens is because the losers are small and because momentum gives you one thing, which is you may end up lower than you started, but it's indicating when there is a positive push in the market, which typically doesn't dissipate immediately. So this is a strategy that has you, and this is hard to accept for some, but this is why I'm encouraging maybe a different line of thinking, but this is the idea of buying high or being a little bit bullish after the market has started to rise, which is very difficult for many, especially market neutral options traders. They're used to being when the market goes up, I'm bearish and I want it to go down. When it's bullish, when my position is bullish, that's because the market has dropped and I want it to go back up. That's typically where we live as market neutral options traders. This is showing maybe there's a way to filter out short-term momentum that says when the market's starting to rise, there's a reason to have a little bit more bullishness in your position, a little bit more allowable risk to the downside, a little less risk to the upside. That's what we're looking for here. And so it may be that 66% or 67% of the trades end up negative on the momentum signal. It is not a high probability signal, and most directional signals aren't. So you have most of the trades end below where you started. But what happens is you've caught some early momentum. You caught the market when it was starting to rise. And then what happens is it typically will go in that direction or at least go sideways for a period of time. It doesn't typically immediately reverse. So you catch that several days of premium decay before it sneaks back below where you started, and then you get your exit signal, and a lot of those trades end profitably. And here we can we can do this. So I'm going to say, I'm just going to get a quick, I didn't do this before, so I'm hoping the numbers add up to what I just claimed. So if this is greater than 0, I'll even do equals, greater than or equal to 0, then 1. I guess I need to put an if in there. Otherwise, leave it blank. Or no, I'll just make it -1. So we have one rule. I'm going to leave it blank. And then this next to it equals if this is less than 0, then 1, otherwise blank. So I'm going to get a quick, it's not going to let me do that. All right, so I have, I did the wrong number. I did the total P&L instead of the trade P&L. So B. And then there's this one spot where I have a quick correction in the trade. Need some Jeopardy music while I finish this. All right. So I have, as far as winners, 73 winners and 59 losers. What did I say? 73 and 59. So this went from a 33% of profitable trades. Let me just make sure I am right. If this is greater than 0, then what? Yes. I went from 33% profitable trades. This is actually better than I thought. 33% of the trades being profitable to 55% of the trades being profitable, because I have premium decay in my favor and I have short-term momentum in my favor, that the market's probably not immediately turning against me. And that's going to give me time as the market maybe follows through for a little while on momentum before it turns and then comes and gives me an exit at a lower level However, after enough time that I had the trade working for me before it went against me. That's very different than I started out as trading, and I see most traders approach the market. They're looking for down days to get bullish, and then the market continues down. They get under pressure. They have a drawdown, and they hope and they hope and they hope for the turn, and then it finally bounces back, and they get their money back and hopefully a profit. Or the market is rising, so it rallies up, and you think this is a great time maybe to be a little bit bearish, sell call spreads, leave your position alone, sit and hope, sit on hands. I'm sorry, whatever SOH means. You know, sometimes I think it's sit on hands, something is sit on hope maybe. Waiting for the market to come back down. This is one where you put the trade on, and typically it runs in your favor first, and then it comes back and gives back some of it, but you're left with a profit more often than a loss, and your losses are under control because you're being told to get out before something big happens. And then when the market keeps going, you let the thing drop down to zero. You take all your premium home with you. So, and just visually as examples, you know, if you think this is a down day to hop in early, momentum's saying to stay out, and there's big drawdowns in the way. Or here, the drawdown, you enter here and you exit here, you get some premium decay over 1, 2, 3, 4, 5 bars, which probably, included a weekend. So you actually get 7 days out of that one. So 7 days of premium decay plus it goes against you. That's a small loss. And then you're out and you're avoiding these 2.5 days where we run all the way down to here on an even bigger move. So that's just the idea of short-term momentum, how maybe the signals don't look that great. Maybe they don't add up to a profitable if you were to buy the index directly. But as a premium decay filter, if you have a 190 exponential average to trade bullish, I don't even have in here. I could add it very quickly. See if I can find it. All right. I can say if value is greater than my favorite one, X average 190. Sorry. Preston, if I do something wrong, just chat in so I don't embarrass myself. If value is greater than X average, so the 190 exponential average, and value is greater than, so then momentum's up, then buy, another one down here, if value is less than, let's do this, replace that. I probably should have done this. What I'll do is I'll take a snapshot so we can remember. Here's the before, so I'll bring that back in a minute. So I'm going to switch this, and you'll see it change. I'm going to add the 190 filter in here, and fingers crossed, less drawdown. So there we go. 190 filter did its job for removing drawdown. Lost my thing again. So this here is with the 190 filter. We have $10,000, about $15,000 less drawdown in there with less total return, but that's fine because we're looking for reducing drawdown. And then we have the momentum signal for maybe short-term momentum when we're above the 190. So again, an equity curve that's not pretty, but I'm not worried about the equity curve of the underlying. I'm worried about the statistics. So this one here, let's find the percentage. Percentage stays low. Trade analysis, what happens is our losers get smaller. So here I drop my size of my losers. I think the winners are about the same. The losers drop a little bit. Winning length seems to have been increased. So my average winning trade is increased a couple of days, and my average loser is about the same. So these are the benefits of adding two different filters together, where the underlying signals don't look that great, but for the options performance is excellent. So on top of all that, you have the 9 exponential average for making sure you don't over adjust and things like that. So I've successfully completed about half of what I wanted to share with 10 minutes remaining. So I don't know if questions are in order, or if I can give maybe a live example if somebody is interested in what a signal would look like statistically, maybe one of their favorite indicators. I can quickly plug it in and pull out the data and maybe give you a spreadsheet for you to go back test it. So that's just one idea.
One question, I think when you were looking at Quanti Carlo, John says, can you use an SMA within Quanti Carlo, or do you need to attach the SMA signals by way of an external CSV file?
SMA is one of the few that you can do. Let's see if I can, again, I'm still a newbie at this, so pardon me as I
think there's a library of trading indicators, and that's probably one of them that's built in.
Here it is. So here's, these are the ones that came with what I did. You have simple, exponential, Bollinger Band on a simple, Bollinger Band on an exponential. So those are the ones I saw in the platform. So that is, I was able to do that back test. Close this, close this. So here's with the no filter, and then this one that has the filter. That was done all inside of Quanti Carlo. It was all there.
And that's the only question that we've had so far. So maybe if you have a few more minutes, if you wanted to go through something live, that'd be great.
All right. So what I'll do, I see a question. Let's see if I can read it. For a momentum indicator, you'd have to use something else. If you can clarify that, a different strategy, I'm assuming you mean use options instead of the underlying. Oh, or maybe you mean in Quanti Carlo. Yes, okay. For Quanti Carlo, you'd have to import that, and I don't actually know how to do that yet. I've literally been using Quanti Carlo for 10 hours. So I just don't know how to do that yet. And I plan to learn a lot more and hopefully interact with those that are using it and get some others to use it and share information as well. So I think, good. All right, glad that was answered. Okay, MAC, can you combine the exponential average so as to generate a MACD? So here's what I'll do. I will do my best because the moving average is the MACD or MACD is, let me see if it's just defined already, MACD. Just taking a wild guess. All right, price length, so I have to define the close and then the standard. So while I'm doing this, if you can tell me, it's kind of weird, I don't want that. Okay, if you can tell me what settings you use on the MACD while I write this out, and then I will do that. So we'll see. Maybe this is going to be better. And I'll tell you right now, if you get an underlying signal that works, which I do have, those are longer algorithms and very complex, and you know, it would take 4 hours to describe the math behind it. It's not that complex. It's just a lot of things. A lot of things are plugged into it to help out. But if you get a positive signal, then you really have a great chance of turning it into a wonderful option system. So I'm just going to define everything simply here. So EMA, you know, this is so simple, I'm just going to write it out. If the close is greater than X average, okay, average close 190, then begin. If MACD, I saw you type it in, of the close is, so 817, so that's the indicator we're plugging in. Very simple. I like simple. If this was Python or C++ or something, then we'd need, 30 more lines of code to be where we are now. So I like TradeStation. If the MACD greater, I'm just going to do rising, see what that does. Or maybe I'll do 0 first, see what that looks like. Then buy 100 shares. Actually, I like nominal values. So we'll do a $10,000 position divided by the close. This bar close. End. Okay, and then if close is less than X average close. So now I'm saying if we close below the 190 exponential average, then we're going to get out. Also, or if the MACD crosses back below the 0 line on the histogram. So then that'll be then sell this bar close, and I don't have to define the number of shares or the size because it just exits the position. So let's see if it yells at me for doing anything wrong. Yep, I can get rid of that. Cool. One mistake in 5 lines. That's not terrible. Insert strategy. Oh, we're lucky. Maybe it does that on purpose. It takes you right to where you were. Turn off the one I was looking at, and let's see if it'll let me do anything. Yeah, it worked. All right, so we've got 10 years. It looks like we got something a little worse than the momentum signal so far. I'm not willing to give up yet. Let's do apples to apples and make it 100 shares. Yeah, still not the best. So now I'm going to do if it's just rising or falling. I'm guessing oh, I see. You can't be higher or lower than yourself, so you have to reference the previous bar. A lot more trades because the MACD wiggles around a lot more, and we have some negative action here. Let's look at the total drawdown, though. Similar drawdown actually comes, there's just a lot more whipsaw. So we have a similar drawdown level, a big recovery, a bigger give back. But here, I'm going to listen to my own advice and look at the statistics instead. Here we have a 9-day winner and a 2-day loser. Very interesting. Probably would lead to overtrading for premium sellers. A little too frequent as far as taking 2-day losses or nearly 3-day losses. The winners are a good multiple of that, but they're not a big distance difference. So far I'm not liking it over the momentum, and you might have a lot more whipsaw and it may have bigger drawdowns in an option strategy, but again, you'd have to test that to be sure. And I'm going to slow. We'll see if we can force it to give us something a little prettier by slowing it down. No, I always do that. The shorter number, smaller number is not always slow. So the smaller number is fast, and slow is 17. Paste, paste. Oh, we got a couple more. Fast, fast. So what I'm doing is I'm setting this up to be a number that we can change. Nothing should change yet. And then, but I can go in here and maybe say 8, 16, 24. So just a couple different there. 17, maybe 30, 17, 34. Plus 30, 34 plus 17, 51. So I'm just going to throw in a couple different here and see if slowing it down. Oh my, What do we got here? So that's curve fitting. If you've ever wanted to find curve fitting ever in your life before, I've just shown you. That's the one set of parameters that turns a profit, and the rest are just completely abysmal. So it was pure luck that we generated a nice equity curve there, but it did move us to the slowest of the fast one. You know what this did? It flipped it. You see that, Tom? It made the fast a little slower number and the slow a faster number. So it's this one optimized to saying doing the opposite makes more sense. That's actually just what happened there.
Interesting.
Yeah, but the problem with that is it's not a filter anymore because doing the opposite means you're going to have drawdowns, and drawdowns are the enemy of a options trade that already has less possible return than the risk that you're taking. So what I'm looking for is avoiding drawdowns, catching momentum while I can. So that one didn't work. I was hoping. I like hearing ideas, but it didn't. Didn't work out.
Curve fitting.
Yeah. Curve fit to doing the opposite. Very interesting.
So the risk is not doing it right. So it looks like we're about at an hour. This is probably a good place to stop. What do you think?
Sure. No, I think so. I hope that was at least interesting, slightly entertaining. It looks like we didn't lose too many people. So if you're inspired a little bit by that and you think this type of analysis is interesting, I'd like to hear from you. So.
And if people want to get in touch with you, how would they do that?
What I'll do is I'll put my SMB email address in the chat there. So I think everybody should be able to see that. So feel free to email me if you have questions or comments about anything I said.
Okay, and I'll put that in the recording. I don't think you have an account with us, so I can create one if you like, if you want to browse around our members area. Yes,
definitely.
Okay, great. Well, thanks very much, Andrew. I'm sure we'll have you back. Really interesting presentation, and I'm sure everyone got a lot out of it, so thanks very much.
You're welcome. Thank you for having me.
Okay, well, we'll see everybody next week, and good trading to everybody.